Hi, I'm Mark Honeybone from Property Ventures, and welcome to our weekly podcast where we interview prominent members of the investment community along with other professionals in the New Zealand property market. This is a free service from Property Ventures so that you can keep current and learn from some of the best around New Zealand. To check us out, take a look at propertyventures.co.nz. We hope you enjoy today's podcast. Hi and welcome back to another part one of a two-part podcast. Today we talk to Kyle Elmer from Dunedin. He's an investor that started with little equity about 10 years ago, and over this time has built up a substantial property portfolio as well as starting up a couple property associated businesses. This is a great listen for anyone out there about to start out or wanting to know more on building a team around you or how to add value, property management, and a heck of a lot more than that. We assure you will enjoy the show. So, welcome to the show, Kyle.
Morning, Mark. How you doing?
I'm doing very well, thanks. Now, Kyle, unlike other people I've had on the show, I've known for longer, but funny enough, I probably know less about him than some of the other guests we've had on. All I know about Kyle is he runs a very good property management business. I've been told he's a very good and shrewd businessman. And I know he's someone that I can certainly rely on, or my clients can, when I've been doing investing down in Dunedin. So, Kyle, that's my sort of introduction to you here. So tell us a bit about who you are and what you do now.
Okay, my name's Kyle Elmer. I've been in New Zealand since 2003 and moved over here from England, if you can probably tell from the accent, when my wife Tanya finally convinced me that this was the right place to come to. And her being a Dunedin girl, that's why we ended up down here in Dunedin for starters. We basically got into property from a family of Tanya's. A cousin of hers gave us Rich Dad Poor Dad, as most people seem to start out. And we went with them on a weekend trip over to Spain, sat around the pool, reading the book, and basically just read that book almost cover to cover immediately. And so we decided to start investing from that.
Great stuff. It's certainly an awesome book to get yourself going and give you ideas and get you motivated straight away, isn't it? And many people have been down the same lines, I guess.
Yeah, exactly. I think a lot of people have probably started out with that book and then moved on to a few more, and then that gets them going. And much like we did, it probably took us about 3 years before we actually ended up buying the first property from that. We did a lot of reading, a lot of planning, went to a lot of conferences and things back in the UK, and then converted that sort of information to how it would work in New Zealand. Tanya actually came back and did a quick recce visit and met up with the bank managers and built up relationships there as well. And so we had all of that kind of in place before we started. So we tend to be a little bit conservative compared to some. But yeah, we ticked along quite nicely.
Well, that's great, and that's certainly people go sort of one or two ways. They get in there straight away, or they come up with a constructive plan. And you say you're conservative. It's a sensible way to get everything sorted, ready to go. So you're in the market, and I'm not sure exactly how quickly went after that. But once you are all prepared with everything ready to go, that's when you can get in and start getting the bargain straight away, I guess.
Yeah, exactly. We took that first sort of 3 years to get cracking, and we were looking, like I say, from the UK. We were buying in Dunedin, and we picked out Dunedin because we felt it was a good cash flow kind of market. Not so much the appreciation side, but more for the cash flow. And with all that research and time that we took, it meant when that first deal came along, we knew it was a deal, and we could pull the trigger and jump on it. And then within about a year or so, we'd actually managed to do another 3 deals on top, and that's where we finally thought, right, now we're ready to actually go back and start running these full time.
That's awesome. So your main strategy is buy and hold, and that's what you plan on doing, or was that the goal right from the start?
Yeah, we've we've predominantly been buy and hold, mainly again from the Kiyosaki style of things. Put them all in your asset column, try and pay down the liabilities, and keep the cash flow. So yeah, we always bought generally properties that we wanted to keep. Well, basically, we bought everything with a view that we wanted to actually keep it as a good rental income off of it. One or two haven't panned out quite that way, but we've got strongly into renovations and adjusting of properties so that we can make them cash flow better, or manufacture some equity or growth. And yeah, when we arrived back in New Zealand, that became a real strength of how we tried to develop the portfolio. But originally, we were probably actually doing better deals when we were sitting in the UK and we couldn't actually see them, and we just did everything purely on the numbers.
Yeah.
More so than when you're here, you probably think about it a little bit too much and try and do a little bit too much. Whereas, like I say, back then we probably did slightly better on our deals.
Yeah, interesting that. And some people were scared off when they had a suggestion maybe of buying something sight unseen. Many of my clients do it all the time. I've had some outstanding buys myself. In fact, most of my purchases in the last 3 or 4 years have been sight unseen. And again, if it comes down to the numbers, and the numbers have to work out well, and you can still get your checks from a distance. You can still get your property managers or your builders reports and valuation. So it takes some of the risk factor out anyway. And again, as you sort of said, I've had a lot of clients they've thought about it too much and haven't bought a property when it's been perfect for what they've been wanting.
Yeah, exactly. And it's a fine line between should I pull the trigger and should I not? And you've just definitely got to be comfy in your own mind that you've done all the research you're happy with. But yeah, we did definitely do. Effectively, we bought our first 8 units rental. We class our portfolio by the rental income streams we get off it. So we purchased 3 deals, but they actually had 8 units in combination for those.
Okay, yeah.
And so before we actually returned, we bought 8 rental income streams, and they were all sight unseen.
Right.
The first one effectively was a Kiyosaki sort of big deal rather than the small deal. If you actually played the cash flow game,
yeah.
The first one actually came along, and it was just such a good deal, and it happened to be a smaller big deal.
Yeah.
It was a block of 5 units, and we actually managed to pick it up on about a 13% return.
Right, great.
It had management issues, etc., and that's where we found and why we've ended up in the property management business is that one of Tan's strengths was really the management of the properties, and she was actually managing to get a better management of that property from the UK, working at 4 o'clock in the morning, 4 o'clock in the morning over there, than the people on the ground here were doing at the time. And that's what gave us that gain in that place that freed up the capital to move on to the next couple and go from there.
Yeah, great stuff. In fact, funny, the first one I ever bought too was like there was a small, the small larger one also, but again, it was a great deal, the right time, right place. So okay. So we have a lot of listeners here, and they're early investing in their career, and they sort of want to know the real hard, cold facts sort of thing. So a few things I've picked up already. So when you go, you're looking at an opportunity to buy in, whether it's early on or even now or whenever. You sometimes will buy a place that's all being renovated and looking good, and because it's a good deal, or is your ultimate goal every time to go there and add value straight away? So it's not going to be that perfect property straight away.
Generally, our ones in the past have always been something that's got a twist in them. They needed, we never had much capital effectively, so we needed to manufacture equity either to creatively manage deposits or any of those sorts of things. So yeah, we would quite often be doing actual hands-on renovation or something like that. Or, like I say, sometimes it's just being poorly managed and it's being sold on the return it's actually achieving. But you know full well that if you go in there and do what you're good at and you manage the property properly and you go and learn how to do that, there's plenty of ways of doing your learning. And yeah, that's where you can add your value, but you've always got to find a way to add that value somewhere. And yeah, we found it initially it was through the strength of management,
Yep.
because we were overseas and we couldn't physically hands on do something. But over time, like for now, we've got less time to be able to put into it, so we're having to do it through other means, and that's sometimes been the actual management of projects. We've actually now got a small building company, so we can keep a lot more of that work in house and control costs and timeframes and things. So that helps as well.
Mm.
But yeah, initially it was just that. For example, the first deal we purchased was a block of 5 terraced houses, and it was originally the firemen's houses, and it was the families of the firemen would be in these houses, and then the young men, as it was back then, would be in the flats above the actual station house. And this building was sold off separately, so we managed to buy that. And like I say, it was under rented effectively at the time and not achieving everything it should have been doing.
Mm.
So we managed to get in there, tidy up the rentals for starters, and then when we came back, we added that second layer, and we managed to do maintenance improvements to it and renovate every single one. And from that, we managed to really increase the value, and that really gave us that first push to be able to start buying further properties.
Yeah, great. And that's the biggest hurdle or challenge for anyone starting out if they haven't got the equity, is they need to add that value. And I suppose especially in the Dunedin market, and as you said, it's a great cash flow market, not necessarily a great equity market, although over time it still goes up, so that's always the positive thing. So you've always had to worry about trying to get the extra equity. So there's people out there in the Auckland market, for example, where they have got things going forward at a great deal. If they can then actually make that happen quicker, by either, as I said, by maybe it's been poorly managed or just adding something to it, or developing, or thinking of a twist to make it better, I guess.
Yeah, exactly. The first one we bought, we managed to get that for 290,000.
Yep.
But it was achieving 35,500 ish rent, so it had a good return on it.
Already good, yep.
But actually, on the last couple of days coming into completing the sale, we thought we had financing to 80%, and then at the last minute, the bank realised it actually had 5 units and pulled that down to 70. So we had to suddenly find another 10%. And fortunately, a friend managed to, they had some investments tucked away that weren't earning much. So we managed to actually borrow that money off them, pay them a higher return than they were getting in, just a term deposit, and still managed to make it cash flow positive and pay them off very quickly so that we could get the deal over the line, like I say, repay them. So that actually gained us some equity straight away, because we now had that money already built up straight out of the cash flow.
Mm.
And over time, that property we like I say, renovated every single unit, one after, both more or less one after another. We went through all of our stock over about a 13-month period, more or less, renovated them all up. But this particular one, we've now held for nearly 10 years, and it's now valued at just over 900,000.
Wow.
And from the additional work as well as the market growth.
Yep.
And I think it's now actually achieving about 73,000 a year in rents. So it definitely was a deal worth getting hold of. And over time, those sorts of things can happen if you set it up as you go.
Absolutely. Oh, that's a great figure. So what was something like a 290k plus what you've added to it and what have you, and 35,000 rent, doubling that to 72,000 rent. That's not a bad result for your first property deal you do.
No, exactly. It works out nicely.
And again, if you hold on to the properties, and that's where I look around the property invest associations of people who've never sold before, they've kept, and they're the sort of results they're getting when they're educating themselves and keeping it for long term. You're getting the capital gains plus adding to the rent, so that's great.
Yeah, that's it, and that's the thing with the longer you can hold them, you get that natural rent increase, or you do if you manage it properly, then you can get those small increases just regularly so that they don't put your tenants off. That building, one of our tenants there has been there probably nearly 7 years now, just happily ticks along. We literally just do as small an increase as we can get away with the rates and insurance and type increases.
Yeah.
And little and often works the best, rather than I'll be nice to my tenants this year and I won't put up the rent, and then that becomes next year as well, and then suddenly you're 20, 30, $40 behind the market, and it's actually done you and also them no favours, because now they don't realise how much the rents actually really are, and they can't sort of move on, and you've actually got to start throwing some of those increases in. And, because your tax and your insurance has gone up. So, it is much better to do a little and often process.
Yeah, there's a great tip for people. Yeah, gradual and often. And it's really, I suppose, with that, just on that topic, it's really hard what to decide to do sometimes. We've got 3 properties I've just put out yesterday to my database in Manurewa, and the investor wants to sell all 3 at the same time. And he's got extremely good tenants in all the properties. They've all been there for a substantial amount of time. But to be fair, I know that market very, very well, and they are all under-rented. He's aware they're under-rented, but he doesn't want to lose the tenants. And there's one with a 3-bedroom, and the 1-bedroom is potentially $60 to $80 under-rented. So it's a fine line. As you said, you don't want to do. I suppose you don't want to do those sudden $60 rent increases. You'd rather do 5, 10, whatever it is, often as you can. Well, within reason.
Yeah, exactly. Yeah, it's amazing how much $5 a week every now and then can mount up to not something that somebody notices, and they can adjust for and they can manage into their budgets, but how much difference that makes to your return and the ability of you can maintain your property properly. You can keep up with all the latest rates and insurance increases and any other bits and pieces, and it's just a stressless process for both sides. Those ones there that you were mentioning, I did notice those, and you can actually manage your way through that process without necessarily having to move those tenants through. So, you get somebody good on the ground there, which I'm sure you've got contact for, then, that kind of thing can be done, and you can get it where, even as a new investor coming in, you can purchase that. You can keep those tenants happy. You can slowly adjust it, and it's all in the communication with them, and keeping it civil, making them very understanding of what the market's actually doing. You may be able to manage that process.
Right. Yeah. So it's interesting. So just go back a step actually in time with you said. So why Dunedin? Obviously, it's where your good wife comes from and dragged you to New Zealand. So that's great. And so why Dunedin with investing is obviously you're there. You become a local expert. That's obviously all important. Do you? I believe most of your investing's been in Dunedin. Do you invest other places also?
Yeah, we do have a little bit of an interest in Central Otago, up around Alexandra, Clyde, Cromwell. Not sort of Queenstown itself, Queenstown or Wanaka themselves, but more the next towns down.
Yeah.
And we do a little bit of management work there as well. And we've just actually gone into Christchurch and done a little off-plan deal there that a few people are probably aware of, knowing you.
Yeah.
And so, we just been up actually at the National Property Investors Conference, and we went round, had a look at the site and did a bit of homework up there. We tried to get into Christchurch around about 2007-ish, but obviously peak of the market, we just couldn't make any deals work. And so we basically pulled out. Well, we basically put offers in and nothing was getting accepted because we had our criteria and we stuck to our criteria, but that wasn't creating the deal. And so, we basically put that on the back burner, but we feel like we've got this chance to go in again now and just spread our risk a little bit around other places in the country, and obviously in a market that seems to be doing reasonably well.
Great. Yeah, just personally, unfortunately, 2007 was a terrible year. I did jump into Christchurch, and the the rest is bad history, but we won't go too far into that today. So well done. And yeah, I suppose with you, the areas you've been into, you've got the really good cash flow areas. I suppose a couple seen opportunities in different parts of the country with better capital gains is going to be, I suppose, will complement what you've already got in your portfolio.
Yeah, we've actually got a couple of clients that are doing that with us now, where they've actually got some investments already in the big centres, and they're coming to us to try and find some, get us to help them find some good cash flow off of properties down here.
Yep.
And so we're managing that process through either finding them where we can just straight up the rents because they have been under rented and people haven't realised what they've been doing properly, or because they need some renovation improvements. And obviously, with having the building industry background, my father was a builder architect. Tanya's parents used to do a lot of renovations as well. So the pair of us have done a lot of renovation and come from that background. So we feel we can help and add that value. And we've done it for a number of clients before where we can sort of project manage the renovation as well.
Yes.
So, we've got some clients doing that now, and they are sort of, like you say, adding that cash flow from here, letting that cash flow effectively pour into a capital gainer that might be a little bit more neutral. And, the whole portfolio you look at as a package now becomes, not so tight on the cash flow, but it does still have the good capital gain.
Yeah, and it's really interesting seeing different investors do different ways that they've done it. And there's the old way of saying you have 3 cash flow and then you buy a high equity investment. In fact, I just had another one in lady in Invercargill. She just brought a couple in Invercargill places, and I know the auctions will be going, why the hell you want to be in Invercargill? But they're exceedingly high cash flow. Even though actually just of late I've heard from an agent down there last night here, it's getting hard to get cash flow like it was 6 months ago or a year ago. But she's now saying, well, hey, now I need to get in the Auckland market, so can you help to do that?
Yeah.
So it's a similar way that you've gone. I guess you've got the cash flow first, and it is good to have a balance. And I know other people in Auckland just will want Auckland, and that's all. And it might suit what they want to achieve if they can, but if you're starting out with not a heck of a lot of equity, you can't always do that also. So you need to do a bit of both. So but there's no right or wrong way. Everyone has their own goals and what they're trying to achieve, I guess.
Yeah, exactly. And there's definitely the thought where you're probably more likely to succeed with the cash flow first and then add the capital gain later, just from a financing point of view and a structuring point of view. That, if you've got spare cash coming in, everything's a little bit easier than if you're scraping and scrimping and scraping trying to make things work whilst you've got the capital gain maybe coming in. But life can be quite tough if you haven't got that cash to keep feeding it. So, and cash flow doesn't necessarily have to be off the properties. It could be off businesses that you've got, and you could, potentially group them in so that the cash flow from a business runs off and feeds a capital gain one, or, maybe your high income that you've got on a good job, that might be the same thing. But, you get in touch with your lawyers and your accountants and, possibly even your property managers and your renovation people, and you put them all down as a team. And it's definitely a team event, and you've got to lead that team, but you do not want to be the most sort of senior person on that team. You want to make sure that they're bringing in their speciality and just getting the balance right, so that they say, yep, you've got your cash flow from either, the property, the business, the job, whatever here, and you've got some gain that's going on there. And if we piece these all together as a package, I think you do this for your tax as the accountant. I think you do this for your asset protection as a lawyer, whatever it happens to be. Your team is the thing. And once you've got those in place and you can sit them all down, or you can put them all in together on a group email, and they all have the chance to put in their input, and you make that final decision from all the information you can gather, you tend to get things ticking along.
Absolutely. Geez, the team, having a team on backing you is so important in the game. And just you personally, did you develop a lot of it before you started, the 3 years before you sort of bought your first property, or it's just sort of evolved since you have got into it?
Bit of both, and I think team will always expand over time and change and morph depending on what your needs and things do. So it shouldn't be a fixed team and that's it, hard and fast. If something needs to change, you're the captain. You need to make these decisions.
Exactly. Yep.
It's your life, it's your investments. You're the one that's got to actually sit down and say, "Yep, I want this to happen. Now you tell me how we make that happen."
Mm.
And if it can't happen, then explain to me why it can't happen, and let's see if we can move it. But yeah, you will adapt that team. But initially, we did get that Tan come over and do that little scouting mission and build up some relationships with people we knew we could trust. Got some legal background, got some financing side of people, got that all built up, and that was good boots on the ground knowledge that you could go to when you needed to, even though we were, the other side of the planet.
Yeah.
And, you still could have that feeling you were on the ground and you knew what was going on.
Yeah, and as you said, you can do it from the other side of the planet, as you said.
Yep.
And yeah, I've hired and fired a few myself, and as I said, the trust is a good thing. If you've got a team, you can just they get what you're trying to achieve. There's a real trust thing there both ways, and it's got to be both ways, not just one way.
Yep.
That's just so important. Just with one thing you said there, I remember doing a deal in Nelson several years ago, and it was a renovation of 4 flats, and I went around. I had my builder there, my property manager there, registered valuer there, and a real estate agent there. So there are four people in the team all walking around this place with me, and all of them talking to each other. It just gave different ideas for the builder to the what the agents said we needed, what the valuer said, and it just turned that sort of hours made that deal a massive success by using just four parts of the clog.
Yeah, exactly. Yeah, because there's no point you going in and buying a building thinking you're going to do X, Y, Z, and then your builder says, "Oh yeah, but that wall there won't do that," or had you thought that room's actually going to be too small for your tenants as your property manager? Because people don't have the small third bedrooms anymore. You want 3 equal size ones, or all of these criteria, and most of them you want to know before you start because they're blooming expensive to fix after the fact. And yeah, you do need that input, and the strength of a really good investor, I think, is more knowing what you don't know and who you're going to ask to get that information, not that you know everything. Because the moment you know everything, you probably don't.
Absolutely. And a lot of people go in trouble through that.
Yeah.
Yeah, and it's great. And that, I've people come to me and they obviously been around the world doing what I'm doing, and I've got a exceptionally good team, and which is evolving all the time, and probably getting more on the team because I deal with different parts of the country, and and I'm more than happy to let people know who's my team and pass them on because it gives me better credibility with my team anyway. So it's not a hide all. It's a share if you have to, but as long as it's my team number one, that's good.
Yeah, exactly. Yeah, you'll get looked after first, then it should go well.
Okay, we'll stop the interview there, and we hope you enjoyed the first part of it. Listen in on the next podcast to get some real gems from Kyle on property investing to save you making mistakes and creating other incomes to subsidise your property portfolio.